Imagine waking up one morning and realizing the world feels nervous. Markets are falling. News anchors sound uncertain. Headlines repeat the same word again and again. Fear. People panic. They sell. They rush to protect what they believe is slipping away. And yet, quietly, almost invisibly, some people are doing the opposite. They are not panicking. They are not rushing. They are positioning. Not because they can see the future, but because they understand something most people never learn. This video is for educational purposes only. It is not financial advice. There are no recommendations here. Only perspective, history, and understanding. Because the biggest mistake people make in investing is not losing money. It is entering the market without understanding the rules of the game. Most people think investing is about intelligence, about finding the next big opportunity, about timing the perfect entry. But investing, at its core, is not an intellectual challenge. It is a psychological one. History shows this clearly. Markets don't punish ignorance immediately. They punish emotion over time. Every generation believes they are smarter than the last. Every generation believes they have finally figured it out. And every generation is proven wrong. In exactly the same way. Let's go back in time. In the late 1990s, technology stocks were unstoppable. Companies with no profits, sometimes no products, were worth billions. People quit their jobs to trade stocks. Taxi drivers gave investment advice. Everyone was a genius, until they weren't. When the bubble burst, trillions of dollars disappeared. But here's the part most people forget. Not everyone lost. Some investors exited early. Some waited patiently. Some prepared years in advance. The same pattern repeated in 2008. Housing prices could never fall. Banks were too big to fail. Risk was hidden behind complex systems, until fear exposed everything. Again, people panicked. Again, people sold. This is not coincidence. It is human nature. Markets move in cycles, but human behavior barely changes. Optimism turns into confidence. Confidence turns into greed. Greed turns into denial. And denial always ends the same way. Smart money understands this. It does not try to outsmart the market. It studies behavior. Smart money knows that prices are driven less by logic and more by emotion. Fear pushes prices below value. Greed pushes them far above it. And between those two extremes lies opportunity. But opportunity requires patience. And patience is rare. Most people want results now. They want certainty. They want reassurance. Markets offer none of those. Instead, markets reward discipline, preparation, and time. Smart investors ask different questions. Not how much can I make, but how much can I lose? Not what's hot right now, but what survives long term? Not what if I miss out, but what if I'm wrong? These questions are uncomfortable. They don't feel exciting, but they protect capital. And protection comes before growth. One of the least discussed truths in investing is that survival matters more than performance. You don't need the highest returns. You need to stay in the game. If you're forced to exit during a downturn, your strategy doesn't matter. That's why risk management is the foundation of every successful investor. Diversification, liquidity, time horizon. These aren't boring concepts. They are survival tools. Markets are unpredictable in the short term, but surprisingly consistent in the long term. Economic cycles repeat. Recessions come and go. Recoveries follow. The problem is timing. People enter markets when confidence is high and prices are expensive. They exit markets when fear is high and prices are cheap. This behavior guarantees poor results. Yet it happens again and again because emotions feel logical. In the moment, fear feels like protection. Greed feels like opportunity. Both distort judgment. Smart money creates distance from emotion. It plans during calm periods, For moments of chaos, it assumes volatility will happen, prepares for drawdowns. It accepts uncertainty as normal. Most people do the opposite. They plan only for good outcomes. They ignore risk during bull markets. And reaction is expensive. Another uncomfortable truth. Information alone does not create success. Everyone has access to data. Everyone reads the same headlines. Everyone sees the same charts. The difference is interpretation. And interpretation is shaped by psyche. Two people can see the same market and make opposite decisions. One sees danger. The other sees opportunity. The difference is preparation. Long-term investors understand that volatility is not risk. Volatility is the price of admission. True risk is being forced to make decisions at the wrong time. That happens when you invest money. You cannot afford to leave untouched. Time is the most powerful asset in investing. Not leverage, not prediction. Time. Time smooths volatility. Time allows recovery. Time rewards patience. But time only works if you allow it to. That's why investing is not for everyone. At every stage of life, if you need the money soon, the market is not your friend. If stress controls your decisions, volatility will destroy discipline. If headlines dictate your actions, you will always be late. This is not a judgment. It's reality. Self-awareness is a financial skill. Knowing your limits is more valuable than knowing market trends. The biggest losses in history were not caused by lack of information. They were caused by overconfidence. People believed they were smarter than the system. Markets are humbling. They reward humility. They punish arrogance. Even professional investors fail. Even institutions miscalculate. That's why systems matter more than opinions. Rules beat emotions. Processes beat predictions. Smart money follows rules, even when emotions disagree, especially then. Over time, wealth is not created by dramatic wins. It is created by consistency, avoiding catastrophic losses, staying invested, letting compounding work quietly. Compounding is slow at first, almost invisible. Then suddenly, it becomes powerful, but only for those who remain patient. In the end, money never disappears from the market. It simply moves from emotional hands to disciplined ones, from reactive minds to prepared strategies, from short-term thinking to long-term vision. The difference between success and failure is not intelligence. It is behavior. Markets will always rise and fall. Crises will come and go. Fear and greed will repeat. The question is not what the market will do next. The question is how you will respond. Will you react emotionally or respond deliberately? Will you chase excitement or build resilience? Because investing is not about predicting the future. It's about preparing for uncertainty. And those who understand that don't just survive market chaos. They quietly benefit from it. In the next video, we'll explore how financial institutions continue to profit, even during economic collapse. And once you understand that, you'll never see markets the same way again.